ready to get started?
Absolutely, yeah.
Okay, so it's a little after 4 o'clock, so we're going to go ahead and get started. And so we're all glad to have you here. If you didn't know what we were having here, it just popped in. This is part of our Advanced Money Management Bootcamp series, and today we're going to be talking about building credit. And so now I'm going to turn it over to our friends at ECU and Colton.
All right, good afternoon, everyone. Most of you I've met before, but just a refresher. My name is Colton, and I'm from Education Credit Union. Unfortunately, I will not be taking up all of your time today. I brought special guests. So Advanced Money Management Bootcamp, for those of you just with us or just joining us for the first time, is basically a building on what we do in the fall with our Money Management Bootcamp series, where we talk about common financial principles that affect college students and give you practical information to where you can make sort of your best financial decision. We talk about credit and the components of credit and credit scores and what they do for you. Today, in Advanced Money Management Bootcamp, we're going to reiterate a few of those things and make sure you have the refresh some of that base knowledge and then enhance it with like what if situations. If you've already found a situation or are aware of a situation where somebody might be in a little bit of trouble with their credit score, tips on how to fix it and what we look at as financial professionals can help you fix it. Before we get too far into the weeds, I want to remind everybody in here, or just ask really, because I'm going to talk at you. This is going to be a conversation. So what is a credit union? Owned by the people and not legally defined. A credit union is a not-for-profit financial cooperative. So everybody's familiar with nonprofits like charities. All the dollars you hand to charity have to go to their stated mission. Businesses are for-profit institutions. They are going to make a profit. A bank is a really great example of a business, a restaurant, a family gas station. Those are all businesses designed to make money. Credit unions fall in the middle, a not-for-profit financial cooperative. So our structure is in such a way as we're going to make a profit. You are going to pay interest on loans. We'll talk about it today. You're going to pay interest on loans, and you're going to pay interest on credit card purchases and all of those things. But why it matters for you to own, to be a partial owner of this cooperative, to be a partial owner of where you put your money, is that that money tends to go back to you in the form of higher interest rates on savings accounts or deposit accounts like checking accounts, or lower interest rates on loans. I do understand that we live in the world of Cash App and Venmo and instant transactions, and those are fantastic tools. Absolutely use them. But recognize that your financial institution of choice, bank or credit union, also has these tools available through their app. And Cash App or Venmo aren't going to get you a car loan. They are not going to get you a mortgage. And whenever you use the features and products of your preferred financial institution, you're building a relationship with them. That makes building credit, what we're going to talk about today, really easy. Or not really easy, but at least a lot easier, I would say. Right. I'm joined today, and who's going to do most of the talking from now on, by Amy McClenny, who is a fantastic team member at Education Credit Union. Can I brag on you? All right, two things that one of the reasons I asked Amy to not only because she's an awesome WT grad, but because that Amy is one of our certified financial coaches who actually has coached the most people most successfully throughout our time as certified financial coaches. So part of my responsibilities is that at Education Credit Union, aside from talking to you fine people, is managing our financial coaching program and pairing our team members like Amy and giving Amy and all the awesome team members who do her work the support they need. We offer free financial coaching, whether that's building budgets, repairing credit, planning for retirement, to anyone in our membership area, anyone in the Texas Panhandle, whether they're members of ECU or not, for free. And again, it's about any financial topic, whether it's one time, whether it's 50 times, every time is free. And Amy is our rock star. She legitimately has seen, my calculation, it's over 100 people now. But yes, and it helps them enhance and reach their financial goals. She knows credit. She's also the assistant branch manager of our Amtech branch. She is the one who trains and oversees a lot of our high school interns before they become WT interns at our Buff Smart group or our AC interns at our Badger Smart branch. She's a rock star. And then lastly, another reason that Amy is super awesome and here today is that Education Credit Union offers the Volunteer Income Tax Assistance Program, the VITA program. And you might have seen it already advertised, but at both of our Canyon branches, Amtech, and at our Badger Smart campus at Emerald College's campus on Washington Street, all 4 of those branches, you can have your taxes prepared and filed for free. And that's not just WT students, that's anyone in our membership area, anyone in our community can come to one of those branches and have their taxes prepared and filed to the IRS for free, no matter how many forms you have. There are things that fall outside of our scope, but as long as your business didn't make more than $35,000 and you're not married filing separately, it's most likely that we can help you. So with that, oh, and the reason I'm bragging on Amy is because currently her team has already, we're 2 days into our filing season. Her team has already filed 11 sets of taxes. Last year, her team filed over 50. Again, she's my resident expert. She's my go-to gal. Everyone, please give a warm round of applause for Amy McClintock. Amy, tell me about yourself.
I'm Amy. I work at Amtech, so it's our internship-led branch at Amtech. We partner with AISD, so all of the kids get to come in any AISD school, and they have 2.5 class periods, and they get to come and get paid to be interns. So they leave their home campus, they clock in, they do their job, they clock out, they go back to their home campus. It's a really cool program that they offered. It's all seniors. We have 6 this year. We have 1 girl, 5 boys, but they're all awesome kids. And then they have the opportunity in our Pathways program to either go to AC if that's where they're going, or if they wanted to go to WT, or to follow all the way through all of them. But it's a really cool program, and I love it. And I love Mr. Barry. So. I have been at the Amtech location for 3 years. I do member service and lending. I do financial coaching. I do VITA program. We do a little bit of everything where we are. But we teach the kids everything that we know. So anything that I know, the kids pretty much learn as well. They actually process the tax returns themselves, and then we just review them. They can continue with the IRS and work after their school years and get paid as well. So that's an added benefit for them. Let's see. I also do Pats's Place. I don't know if you know what Pats's Place is, but it's for women that have been incarcerated, and we teach them an 8-month series of financial education, and we do budgets, and we help them get back on their feet. We help them purchase vehicles and then get into their own apartments afterwards. We're able to stay with them afterwards, but we kind of concentrate for that first year with them, of them getting back into society. It's a really cool program. I'm on my 2nd one now, so I love it there.
That is really cool. All right, so down to the brass tacks, Amy. We talked about the components of credit scores, and most people in this room. Now, I do want to encourage you to engage, ask questions. The vibe of Advanced Money Management Bootcamp is you've already know the basics, or you've already had some experience. So we do want to answer questions or field questions, I don't know about strong answers, but field questions about those weird things that you might have encountered or heard, information clarification. But before we get too into the weeds, let's review the basics really quickly. The 5 components of the FICO credit score.
So payment history, do you make your payments on time? How often have you been late? 30, 60, 90 days makes a big difference in your credit score. The amount owed, the total capacity, so debt versus income. How much you're bringing in, how much is coming out. It's a big portion of it. Length of history. If you have 12 accounts that have just been opened over maybe the last 6 months, you have a lot of credit, but you don't have long-term credit. So that's important as well.
And so length of credit history is the one where I sort of get a little salty, if you recall. So length of credit history tends to be, it's the average age of your active lines of credit. So follow me. If you've paid off your car, is it active? No. And then if you closed out a credit card and can no longer charge it out, is it active?
No.
There you go. So when we talk about the average age of your active lines of credit, I paid off my car and my credit score went down immediately. It will, the system will do that. It will bounce back up in 4 to 6 weeks. But it's because the way the system is bound, it still considers that line of credit active, that car to be active until the next cycle. So, but really it's the average age of your active lines of credit. So yeah, when we see that you might have 12 credit cards, like you mentioned, and you've only had them all 6 months, well, that's, yeah.
We want you to have them for a long time. Keep your balances low, but keep those active for as long as you can, revolving lines of credit especially.
Absolutely.
A mix of credit, so secured versus unsecured. So anything that's secured is a vehicle. Unsecured would be like a line of credit, a credit card, etc. You want to have a healthy mix of both. You don't want to have a whole bunch of credit cards and then, go ahead.
What about HELOC?
Oh.
So that is a secured line of credit. Those are typically longer. Yeah, so those are good for you too, but then you have to think that balance is usually pretty high as well, right? So that's going to affect your debt to income. So yes, it is good to have. Just make your payments on time.
Yes. And HELOCs, like you mentioned, are home equity lines of credit. That's what a HELOC stands for. They are beneficial products, generally speaking, but as you said, they're secured forms of debt. Now, remind me, what is the difference between secured and unsecured debt?
the asset behind it?
There's an asset behind it. Well, behind one of them, because unsecured debt has no asset. But a secured debt is something, like she mentioned, a car. And in a home equity loan, what do you think that collateral would be? Your home. So home equity lines of credit, home equity loans, really useful tools, beneficial tools. They help people start businesses, put their kids through college, whatever it is. But recognize that the security in that line of credit is going to be the asset itself.
Yeah, very important. But you need a mix of both. So whether it be a car or it could be a line of credit that's secured as well with your funds. There's other ways to do it. But yes, having a healthy mix is very, very important on your credit score. New lines of credit, new applications for credit. This is a hard one because you want to open new lines of credit, but you don't want to open too many at a time either. You still want that history, that length of history. If you're opening a whole bunch, it kind of looks like you're out shopping for credit, which is not necessarily a good thing because why do you suddenly need a bunch of credit, right? That could be a factor of like, oh, something's going wrong in this person's life that they need all this money all of a sudden. So having a mix of all of them is really important.
Okay. Now, my question, and I've asked this before, and it's something I like to highlight when we initially talk about credit as well. Why does this exist? Why do we have this? What is credit for?
Because emergencies happen.
Emergencies happen, absolutely, but couldn't we save up an emergency fund? Couldn't we budget? My favorite word. Couldn't we budget and just have an emergency savings to take care of whatever it is that we need? Why does this exist?
We could save up money, but it's more important, or it's more beneficial to have an emergency fund just in case.
Absolutely. Why else? You need, yes.
Does this build a picture to the person who's lending you as to whether or not you would be able to, or you have a pattern of history that indicates you okay at that?
Well, because what if a car? Can you really save up these days $80,000, $90,000 for a brand new vehicle? That's hard. You're going to have to lend eventually, or borrow eventually. We're going to have to lend. So we have to know that you are credit worthy, that you've had experience, that you're paying your things on time, and that we want to lend to you, right? So yes, it is very important to have all these.
Now, one of the reasons we demonstrate the FICO credit scoring breakdown, because there are multiple credit scoring models. You might go to markets where they use Vantage Score. There are products like Chime or SoFi. There are online things that are being commonly offered. 90% of lenders in the United States, currently, 90% of lenders in the United States use this scoring system. So if you can maintain this scoring system, all the other scoring systems will generally be a little friendlier. Clear. So the basics are there, and we need credit essentially, yes, in case of emergencies, but to determine whether or not all this activity measures is how well you fulfill the obligations of a loan. Do you make your payments on time? Do you overextend or overborrow? Do you ask to borrow money often? What kinds of debt do you like to use? And then how often do you ask to borrow that money? That's it. And so knowing that we only use this to determine whether or not a person borrows and returns money responsibly, that's the key. And that is how you're going to get your mortgage. Also, what is the second most important thing that your credit score can do for you or does for you on a monthly basis? There it is. So it not only determines the cost of goods and services like when you get a loan, right? Like your credit score determines the person's interest rate. Amy, you're an assistant branch manager who does loans. So how do you determine a person's interest rate? What does that look like for you? When somebody comes into your office and sits down at your desk and says, I'm looking at a car, and what do you do? Start to finish really quickly.
Application. We look at the application. We ask you where you live, how long have you been there, how much do you pay in rent? Then we pull your credit report and we see what that really looks like. Credit card payments, house payments, rent, etc. And then we look at the credit score. Are you A, B, C, or D? And then that determines your interest rate at that point. So from there on out, that's your interest rate. Like it doesn't move until your credit builds, right? So you can go anywhere from 8% to like 17%. And that's how much interest you're going to pay back. Your monthly payment is dependent on that. If you have, a $10,000 loan, you can pay $100 a month, or you can pay like $600 a month, depending on that interest rate. It's really important.
So yeah, your credit score not only determines the price of that loan, but your auto insurance provider, like your friend in the audience knows, your auto insurance provider can and does use your credit score to determine your level of risk, to determine your auto insurance premium. Now, there is a word for people who don't have credit or access to, or have not participated in our credit system. We call them credit invisible, yes?
Yes.
A credit invisible person is a person who is not engaged. I don't have a credit score. I've never applied for any loans. I don't have any loan product. That's great. That's fine. My auto insurance, like, how do they do that for me? They're going to do for you what we do for people with getting a first-time loan. They're going to get you a C or D rate. We don't know if you pay your bills. We don't know if you don't pay your bills. So you are going to pay higher than usual than you would on an auto insurance premium being credit invisible than you did if you had A+ credit. There you go. Now, when we start talking, the two things, remember, that you need credit for: get a loan to buy a home and to keep your monthly auto insurance premiums low, if nothing else, and the cost of loans low. But we don't need a lot of elaborate borrowing behavior. What is the best way for a person to begin building credit?
Definitely a secured credit card or a secured line of credit. So you put the money down, you throw it into an account, you borrow against whatever funds that you put up. It's the quickest way to build your credit. It shows payment history, length of activity, making your payments on time, and it shows that you're responsible with that money. And then over time, you've built a relationship with your financial institution as well. They're more likely to lend to you at an unsecured, like a credit card, a regular credit card, not a secured. Pay your payments on time. Rental payments. You can have Excel, you can have your rent, you can have all this report to your credit report as well. And then we can look at that history and it will help your credit score as well.
So there are 3 credit bureaus in the United States. The 3 main, there are actually like more than 40, but there are 3 main credit bureaus in the United States: Experian, Equifax, and TransUnion. And Experian is generally the friendliest. They're the ones who actually, I believe, have a form on their website.
Yes.
If you do want to report your rental or utility payment history, by all means, they will allow you and continue to monitor that, rather than you take on debt, borrow money, and then pay it back. What should you do if you ask them to monitor your rent or utility payment history? Thank you. Louder for your friends. You
Pay on time.
pay on time. You would think you would need the reminder. Alas, we've seen horror stories. So again, automate your payments. And I know it sounds like scary. I won't call on anything out. I'm just going to tell a personal story. I didn't start automating payments until I was in my late 20s. Like, it was one of those things. I grew up with, like, when I was a student at WT. You know, sometimes the money's there, sometimes it's not. And so, like, you need, like, I don't know who's going to be there on the 17th. You can make that the due date. And so I really, for many, many years, I was a manual payments person. I know the automated number for every one of my bills. But I can tell you that automating your payments, not only, most companies will offer you a very small but noticeable discount if you automate your payments, but then 2, that also enhances your relationship, especially if your payments are automated with your lender, with your financial institution of choice, bank or credit union. Again, that shows us that you're trying to maintain a positive relationship. Even if it's difficult, it shows that you're trying to maintain that positive relationship, which can make, like, iffy credit decisions. Be honest, and you can be entirely honest. Protect member privacy, of course. But have there been iffy situations where you wanted to advocate for a member to get a loan that maybe the numbers didn't really work out in their favor, but you trusted them?
You fight for that person and you tell them, okay, look, this is what I need from you. If you were going to do this loan and we're going to stick our necks out, I want automatic payments and I want your direct deposit. That way we can guarantee that you're doing the right thing. You're building that relationship with us. We're showing that you're giving us your direct deposit and trusting us, and you're setting them up on automatic payments. Even if that payment doesn't go through on that date, we have a grace period that we allow for everybody, but it also shows that you're willing to give us what we need, so we have a little bit more trust too. So it's really important.
Yeah.
And yes, it was the deciding factor on that loan. So
it's the little things.
It's the little things.
Absolutely.
joint and we were married and this was $100,000 vehicle, we offer life insurance so that if one of us were to pass away, it would cover the entire cost of the loan and the other one would get that title free and clear and that vehicle's done. So they wouldn't be responsible for that additional debt if something like that were to happen. And during COVID, we found that this was very, very, very important. A lot of people didn't have it and then ended up in a lot of debt that they couldn't afford and were surrendering things that they shouldn't have had to surrender if they had these products. Gap is, you know, the difference between what the insurance values the vehicle at and what you owe us. So if that car is totaled out at 30,000 and you owe us 35, you still have to pay us 5,000.
Or it gets tacked onto your next car loan and your next car isn't worth that additional $5,000. And so that you're already starting a new car loan upside down. So those little loan products, it does sound like, and no matter how you position it, whether it's a credit union, whether it's a bank, or some dealerships offer similar bells and whistles, but again, for a higher cost traditionally than a financial institution. But it does sound like they're nickel and diming you, trying to ask. But that's also why you can shop around for your rates. Remember that, yes, it's Education Credit Union giving this presentation, and that, but these aren't features like that we just have. And there's no limit to the number of connections that you can have to any financial institution. So if you don't like our auto loan terms, you can go to another credit union, you can go to another bank and still have your accounts with us, and you have an account with them too. This is where you get to choose where to do your business. And that's why it's important to ask about those bells and whistles and what it costs. Because it's important to know that our gap is the cheapest in the panhandle, our debt protection is competitive with others, and then some places don't offer it at all. But you don't know if you don't ask. And so again, that pre-approval time is not just to make sure that you'll be guaranteed whatever the funds are, but it's a really great time to ask those questions and come prepared to whatever dealership you're going to with answers.
Well, and part of the pre-approval process too is to say, hey, look, I can afford $500 a month. What loan amount should I be looking for? If I go to a dealership, I don't want them selling me a $90,000 vehicle. I can only afford a $30,000 vehicle. Well, let us pre-approve you first. Let's tell me what payment you want and let me structure that loan so that I can help you be better prepared when you do go to the dealership. Show me only this section of vehicles or used vehicles or whatever it is so that you know what you're shopping for as well. Come a little prepared. The more you know, the better you're treated. So that's important.
Yeah, I love that. So, and this sort of encapsulates, the pre-approval process is sort of where, who's heard of the 3 C's of credit before? Character, capacity, collateral are the 3 C's of credit, generally speaking. It's a very much a bird's eye view of what we're talking about. And so we say character, that's what we're talking about, job time. Are you going to have an income to make this car payment for the foreseeable future? If we look and see that somebody changes jobs every 2 or 3 months, or there's every 6 to 8 months, there's like a 6-week, 9-week gap in employment, and we can see that happens at least once or twice a year. That's where the character, it's not like you as a person, it's your situation. So job time, capacity, again, who do you owe money to? Credit report history. We're looking at the amount that you have owed, that debt to income ratio, that's capacity. How much of a bill can you afford? Because I always like to remind people, especially in financial coaching, that it's a loan this month. It's going to get you into a car. It's going to get you something that you want. But next month it's a bill. So can you afford another bill? That's the question that you're asking. And then collateral, again, if it's a secured or unsecured loan, which is secured debt, does that have a higher or lower interest rate than an unsecured debt?
Much lower.
Across the board. It doesn't matter. Like no matter the kind of loan, we're going to talk debt consolidation here shortly, things like that. If there is any sort of collateral, you're going to pay less extra money overall. No matter what your credit score is, you're still going to pay less extra money on a secured versus an unsecured loan.
Like half as much interest a month.
There you go.
Yes.
Now, debt to income ratio, remind us. So give a highlight really how we look at that because, yeah.
So debt to income, how much debt do you have every month, your monthly payments versus how much you're bringing in every month? So
do I mean groceries?
No. Bills, anything that shows up on your credit report and your rent or mortgage, that all counts. So if you pay $1,000 a month in rent, that counts. We're adding that. Credit cards, vehicles, we don't count insurance payments. Childcare does not count. Anything that's going to report on the credit bureau as a line of credit or a trade line, as we call them, that's what we're looking at. That's the minimum that you're going to pay, right? And then we can figure out what you have left budgeted for the month. And then it kind of calculates normal bills too, right? If you only have $100 left for the month, you can't afford to live at that point. So we're probably going to say no thank you.
Or ask a lot of questions.
Or ask a lot of questions.
What kind of questions? This is when we kind of get nosy. I like to say is somebody helping you pay? Are you a co-signer on this? Is a good question that I've asked before. That where your name shows up on a credit report. So this is also a really good time to say, especially if somebody surprises you with you have a 62% debt to income ratio, because that's over half of your money is obligated before you've accounted for groceries, before you've accounted for anything else. It's over half of your, so we're gonna ask them, again, is your name just on this, or is somebody else maintaining the responsibility for this bill? Are you splitting this mortgage with somebody else? Are you splitting it, that kind of stuff?
Exactly.
That is how we can manually alter debt to income ratio based on a conversation. Yes?
Yes, it's very important to have those conversations and be nosy. I know a lot of people get concerned when we ask all those nosy questions, but the mortgage is in your husband's name and not yours? Okay, so you'll split the mortgage. No, my husband pays for it. Well, then we'll take it out all together. You're not responsible for that. He's paying it, it's not in your credit report. That's gonna drop your debt to income significantly, usually. That's a big one. So we do ask those invasive questions just to get to know you so that we can help you better in the future.
Now, when it comes to, now again, this is the building credit part. I don't think I zoomed in here. But yes, when it comes to improving a person's credit score, and this is why I love that you're here, because you are the financial coach who does this. Because we track in our financial coaching program credit score migration. Our goals as financial coaches, as a team collectively, is to increase your savings account by 10%, decrease your debt by 10%, and improve your credit score by a letter grade within 1 year. That's our goal. Save more, spend less, and improve your credit. And so the tips to improving credit, take it away.
So credit cards, if you're just making the minimum payment every month, guys, it would be 25 years until you have that credit card paid off. Even if it's only a $5,000 credit card, yes, you're gonna pay on it for 15 years. You've got to make more than the minimum payment, and you can kind of calculate that by, I want to pay off $5,000 this year, so I need to pay how much a month extra on this credit card. It decreases your capacity. It shows that your payment history is better, but it's also going to increase your credit score. Don't close them out once you get them paid off. Don't close them, because then you've lost all your history. You've lost the length of time that you've had at your payment history. All the good things on this is gone. Snowball method is the biggest one that I sell to everybody. If I have
Who's heard of the snowball method, really quickly? Who's heard of the snowball method before? All right, so for the rest of you, reiterate.
Snowball method is when you double payments on one, make the minimum on everything else, and then when that's paid off, I was paying $200 a month, plus the minimum payment was $100. So now I've got $300 that I'm going to apply to the next credit card, and I'm going to pay it off. So we usually start at the lowest balances so that you see progress faster. So we're going to pay off all the small ones, and then you keep adding that payment every time, right? Because you're already making those payments every month. So you just take the payment you were paying versus the minimum payment, and you add it to the next one, and you just snowball until you get them all paid off or paid down significantly.
And you'll see, so spoiler alert, we talk about investing in a few more weeks. And when we do that, our team member, Jim, our team member who did that, they started as a household, as a couple, paying down their debt via the snowball method. And then, so you're used to that money going out towards the bill every month. And eventually what they ended up doing, since they were already used to that money going out for bills, when they had no more bills, that's when they started their investment journey. And I cannot wait for y'all to hear that story, because it really is a cool one. But it's practical. It is not having millions of dollars or getting some sort of lottery winnings. It is, you're already paying your bills. You already have a structure for your income. And just applying that structure to your benefit is what you're doing. And so, yeah. Keep going. I'm so sorry.
No, you're good. Revolving debt to installment debt. So
Okay.
It's usually debt consolidation. That's a really important one. When you restructure your debt from revolving credit to a personal, to a fixed rate, fixed term loan, you're paying it off faster, you're paying less interest. It restructures your credit score, kind of.
Yes.
So it takes what you have and the capacity, and it's taking all these different things and it's throwing it into a fixed term, fixed rate loan. You're paying it off faster. You're not paying revolving interest. It's a lot better. It helps people boost their credit scores up. You still don't get rid of the credit cards. Don't close them. Keep them open, because you still want to keep that credit history, right?
Build that relationship.
Build that relationship. But then we can help you restructure it, get the big ones paid down, or a whole bunch of small ones, get those paid off. And then it builds your credit score back up. And then we can refinance some of the larger debt for a lower interest rate once your credit score is up and the interest rate is down. So that's important.
Debt consolidation is one of the biggest tools, especially with our financial coaching program. So many people, especially over the last few years, have lived on credit cards or supplemented their living with credit cards. They'll alternate bills, like I'm gonna every other month pay their electric bill on a credit card, and then so that balance kind of ticks up, and up. And now they might be in a fine financial place, but they have significant amounts of credit card bills that they're just trying to pay down and pay off. And they come to us going, I want a debt consolidation. So there are two kinds of debt consolidation. There's a secured debt consolidation and there's an unsecured debt consolidation. Your credit score will sort of determine which path is most beneficial for you. A lot of people generally assume that a debt consolidation is an unsecured loan. Is that always the case?
No.
So for instance, I protect member privacy, so I'm trying to like erase names and text. But so there was a couple. They came to us. They had a collective about $80,000 of unsecured debt across credit cards and just personal loans. About $80,000 of unsecured debt that they wanted to pay down. But 14,000 of it was a car. But other than that. So the rest of it was like unsecured credit card debt. And they great jobs. They had generally positive credit scores. But Amy, are we going to loan anybody $80,000 that's unsecured?
No.
So there you go. So then what we do is for large amounts like that, or for people with if your credit score is not A or A+, what we really encourage when it comes to debt consolidation is basically a secured loan. It's like an equity loan out of the value that you have in your car or some other asset that you already have value in. Because what does that secured debt do for your interest rate?
Lowers it.
Cuts in half. For that debt consolidation, we borrow against the equity in that car. That means your interest rate is so much lower. Yes, that car does become the collateral, but you're already paying on it. And it's paying down that eventual debt. It's safer for us, it's cheaper for you, and you still get to consolidate that debt. But large amounts of unsecured debt, that is not something your local financial institution is going to take on, generally speaking. There are the credit consolidation and credit counseling services that might remind you that those are for-profit companies that are structured differently. So if you do choose to participate in those kind of programs, recognize that they are for profit. Recognize that you need to read the terms and conditions. I know you heard me bang that drum in Money Management Bootcamp in the fall, but reading the terms and conditions, especially of a loan, is important, especially a credit consolidation. Some of them will not pay your creditors until you've paid them a certain amount of money. So then it shows up on a credit report as you not making payments. I turned it over to this company to handle my debt. They're not going to pay anyone any money until you maybe paid them $20,000, and that's going to be some time. And so your credit is going to take a hit in that interim. We've seen that happen. So understand what you're getting into, but really leveraging the local tools that you have available, that's what's going to be best in that situation. So debt consolidation, balance transfers, remind me what those are that you need. Balance transfer credit cards.
Oh, credit cards. Oh, definitely. Oh, this is so important. You know how you get those things in the mail? I don't know if y'all do, but I get 100 a month. And it says 0% interest for 21 months, right? So doing balance transfers, you're still opening up a new credit card, but in this case, that might be better for you, right? So 21 months, let's say 18 months, 21 months, whatever they are, 0%. You can transfer the debt that you have on this credit card over to this one, but you have to remember that if you don't pay it off in that 21-month interim, they're going to charge you interest on the entire amount that you transferred. Usually there is a transfer fee too. It's either sometimes they'll do 1% of the balance or $5 or $30 to transfer it over. But just remember, if it's $5,000 divided by 21 payments, right? You can pay that off in 21 payments at 0% interest. And again, it's going to build up your credit score and you're going to get it paid off a lot faster.
The last option, of course, is similar to debt consolidation and kind of like a balance transfer, but it's refinancing, which is basically just renegotiating the terms of your loan. If you know that you participated in positive credit behaviors, you paid more than the minimum, you paid off loans early, all of those things, and you know your credit score is improved, but you have 3-4 more years on your car loan, and that's at 10 or 12%, and we have rates as low as 8% now, well then you can refinance. You can take your loan from the dealership, you can take your loan from another financial institution and say, I want to do business with Access, with ECU, with Santa Fe, with whoever has the better offer for you. You can take your loan at any time. That's refinancing. So even if we weren't the ones to give you the loan, we will take the loan from somebody else, or vice versa. If our terms aren't good for you, you can take your loan from us and somewhere else. Don't tell anybody else that. One of the best tips that I like to tack on at the end is sort of budget for a new monthly loan payment. When I started the financial coaching program, that was one of the first things I most often heard, and I know you've heard it too as a loan officer. If you just give me the loan, I can make the payment. Prove it. Save what you think that payment should be. Like if it's a difference between a current bill and a future bill, save that difference. If you can really do without it, and we can see that you kept it, like you've done it for the last 3, 4, 6 months, then yes, that's another thing in our chamber. Even if your credit score is kind of iffy, even if we can argue that, oh no, we told them to do this and this is how they improved. And not only are we their primary, not only do they have automated payments, but also they've actually saved the difference in their loan. Yeah, we can make it work. That magical number. So unsecured debt, credit cards specifically, 40%. You have a credit card with a limit of $1,000. You can keep $400, 40% of it hanging out there. And it's not really going to hurt the amount owed. The more you, like you have like 6 credit cards, and they're like, but you want to keep your total borrowing to about less than 40%. Fun fact, this isn't the home buying one, but again, spoiler alert. Credit score is 670 and a debt to income ratio of less than 45%, 670 or higher, debt to income ratio of less than 45%, you can have a mortgage from Education Credit Union. That's our thresholds. 670 or higher and a 45% or lower debt to income ratio. You can talk about a mortgage. Oh, that's 670, might not get you the interest rate you want, but you can start having that conversation. That's kind of what you're looking for. And again, read your terms and conditions. And I always tell everybody to beware payday or title loan lenders.
I just had one the other day, and they wanted to.
Yeah, talk about it.
Let's pay it off. I can't get out from under this. My balance keeps going up. I borrowed $5,000, but now I owe them $6,800. What's happening? Well, yeah, did you realize that you're at 121% interest? That you're making the minimum payment, but your balance goes up, and it will continue to go up, even making those minimum payments.
And if you don't pay off, payday lenders operate on 2-week terms. Paydays. So they generally operate on bi-weekly terms. Your interest rate compounds at a different rate. If you do not pay them off within that designated window of time, that 2-week or 10-day span of time, when they, oh, don't worry, like you'll just owe us, they open up a new line that's like your credit is being hit every time. When they redo that loan, they're providing you a new loan product. So it looks like you've taken out 68 loans in a year when you just every 2 weeks need to keep paying these people.
You almost never pay them off. It's too hard. You're paying them way too much interest. And like, let's say you borrowed $5,000, you might end up paying them $21,000 back. Is that really where you want to go with your money? You're just going to throw away that amount? No. So we'll restructure that. First, we'll find out, again, conversation, why did we have to have this money right here, right now? Why didn't you know any better? Okay, well, cool, let's teach you. Let's do some financial counseling. Let's do some coaching. Let's do something. And then let's talk about it. And then if we can, let's do a debt consolidation. Let's pay that off. Let's get you in a better place. Let's get you out of that 121%. And I saw one the other day that was 129% interest a month. It's revolving. It charges you off to the balance that you owe every single month. They had it for almost 2 years and then had already paid, I think it was like $8,000 in interest, and it wasn't going down. They were getting nowhere. It was messing up their credit. It was just an absolute horrible thing, and we were able to help them.
And they don't build, not only do they actively keep you in a cycle of debt and all that stuff, they don't report positive history.
Right.
They're not obligated by the same rules that most lenders are. Again, that's why they can charge you interest multiple times or higher than usual rates of interest. Like no financial institution is going to charge you 129% interest. That's usury. But payday and title loan lenders operate under different rules, and they're not legal in all 50 states, which is your first red flag.
Yeah.
So, again, make sure you build, and that's the importance of building a relationship with your financial institution of choice. You can have a favorite community bank. You don't have a favorite global or national bank. You just don't. They're terrible. But you might have a favorite community bank. You might have a favorite credit union, and that's the people that you want to build a relationship with. They are going to be the ones to sort of get you out of that trouble. Remember that most credit scoring models that you use are going to range from 300 to 850. The last thing I'll say is when you see the words rates as low as, that means you live here. So your lender, whoever, you're a federally insured lender, not everybody, but your federally insured financial institution, we are legally required, Regulation D, We are legally required to tell you how much you will spend when you borrow from us. And that's what us fulfilling that obligation. We put that on our website. We put that in our advertisements with APR, annual percentage rate, rates as low as. And we're going to tell you. Now, we're going to tell you the whole tier, but you can at least go to their website if that's where you're thinking about getting your loan and where they're starting. Are they starting lower or higher than the next person and the next person and the next person? And that's where you start your journey. Questions, comments, concerns? Yes.
So I have a credit card that recently expired, but I've not gone around and get a new one yet.
Mm-hmm.
How does that work?
So your credit provider should automatically mail you, like mine for work, it expired in January. So I got a new one sent to my office from our payments department, but it should arrive before your previous one expires. If it doesn't, contact them, make sure that line of credit is still open. Sometimes if you haven't used that credit for 6 to 8 months, they'll automatically cancel you and not tell you and not send you a new one when it's time to renew. So confirm that if you didn't get a replacement card, make sure somebody else didn't get it. Make sure that line of credit is still open and that everything's on the up and up. That's if something unusual ever happens, even as small as I didn't get a replacement card, you need to call someone and ask those questions because you make sure that your credit is being unaffected by just somebody's clerical error. Who wants the opportunity to win $50? There we go. All right, let's take a quiz over what we just talked about. How about that? Oh, yes, Kahoot first, and then we'll draw for the winner. Yes. Thank you for your All right, last round while we get everything set up. One more round of questions, comments, concerns. What happens if I? What do I do when? Amy, thank you so much. There we go. Yes, absolutely.
So you were talking about whenever a credit line could deactivate your card or whatnot. Now that lowers your rates, say less than if I close it. If they close it,
It's the same.
It's the same.
It's just a closed line of credit. That if you had it for 10 years and it was closed, doesn't matter who closed it, it's closed now.
Yeah.
So now you've lost everything. If you're going to take a dip in your credit score, it's going to go back up. But yes, you've lost that history reporting. So it doesn't matter who closes it unless it was like a charge off or something like that that's going to affect you negatively. As long as it was just like non-use, then it's the same whether you called and canceled it or they did.
Okay. Vocabulary term, Amy, you just used it. Charge off. Your financial institution of choice on your credit report, and there's only, and I've mentioned this before, but there's one website mandated by the federal government to give you an accurate credit report. What website is this? Annualcreditreport.com. That is the one website mandated by the federal government to give you an accurate credit report. And again, whenever you close out accounts, that adjusts that length of credit, your average age of your credit. So that's why it will take that due. Oh, but charge-offs, that's where I was. Charge-offs, vocabulary term for us, if you do not meet the obligations of a loan and you refuse continually to make payments, and just we never see you again, eventually we'll stop calling you and we'll call that charged off. We accept that we're not, a charge off means that lender has accepted that they are not going to receive that money. If they do, it's a happy surprise, but it is not a favorable mark on your credit.
We will keep it on your credit report for 7 years.
Yes, it does.
It will affect you negatively.
It is negatively, and see, okay, so people like, it'll fall off after 7 years. Nothing falls off. It negatively impacts you. We see that you went over your credit balance in October of 1996. We see that you missed a payment in March of 1983. And we see that 6 years ago, JCPenney's charged off a credit card for you, and it's still negatively affecting your credit. Everybody in? Who wants to be in? This is fun prizes. We're not drawing for $50, but this is just fun prizes. I will draw for $50 at the end of the quiz.
Hold on.
We have one more.